Hello and welcome to Your Money, Their Hands. And this week we're at BlackRock to talk to Mark Lyttleton, the co-manager of the Absolute Alpha Fund. Mark, one of the things that intrigues me about the Absolute Alpha Fund is that most unit and investment trusts seem to have a benchmark, the FTSE 100 or the All-Share Index. For your fund in particular, what gets you out of bed in the morning that makes you feel, I've done the job?
Yeah. Well, I haven't done the job when I get out of bed. I do it when I go into bed at the end of the day, hopefully. But what I'm trying to do in this fund is just make people money. I think when investors, man on the street, goes and buys a unit trust, he doesn't go and buy a unit trust thinking, haha, I want to go and beat the all-share. He thinks, I've got some hard-earned savings. I want to try and make some money. So, you know, that's the way they invest. That's the way people invest. And all we're trying to do with this fund is try and deliver on what a lot of people promise is to actually make people money. So if at the end of each day or the end of the year I've made people some money, I kind of feel it's job done.
It's been worthwhile. You can sleep easier at night then.
I sleep easier at night then. There were times last year where we weren't sleeping quite so easy. There was a lot of turmoil, a lot of things going on.
Looking at now, I mean, since March,
yeah,
the lows of global markets, let alone the FTSE and the all-share, it's been a good time to be an investor and a fund manager, hasn't it?
Yeah, it has been a good time, yes. But, you know, that's a 6-month period, and when you're looking at people's savings plans, pensions, I think you've got to take a longer than a 6-month period. You know, you've got to take a 5, 10, 20-year period. You look at what the UK market's done over the last 10 years, and it's gone precisely nowhere. You know, we've had a great 6 months, but the market is almost flat on where it was 14 months ago, just before Lehman's.
Looking at your portfolio, I was quite interested. You have the sort of 2 to 3%, nice, sort of small, but relatively significant stakes. But there are some consumer-led companies, Vodafone, the supermarkets, William Morrison and Tesco's. Do you see a bounce back in both consumer confidence and spending looking forward to 2010 then? I'm
actually quite cautious on the outlook for the UK consumer. I think 2009 has been a great year for the consumer, and the consumer has gone out and spent, and we've seen it with you know, with the performance of lots of the companies, both in terms of their share prices, but also in terms of their operating businesses. I think 2010 is going to be a lot tougher. Tax increases, whether it's VAT or income. I can see rising unemployment in the UK. And so I think, you know, savings ratio under pressure, and so I think it's going to be a tougher year. The reason we hold those shares is actually they're very defensive in a tough environment. So they're one of the advantages.
People have to eat and they'll never give up their mobiles.
Yeah, well, pretty much that is the case. Yeah.
But I noticed. Am I right in thinking in the top 10 holdings, only one bank, Barclays?
Yep.
And do you have a fear for the banks still that? They're still not out of the woods.
I'm a lot less worried than I was 6 months ago. I think a huge amount of what needed to be done has now been done. The banks have raised a huge amount of new capital, shoring up their balance sheets. Businesses recovering. They're still not lending aggressively, but on the other side, margins are beginning to improve, which is a good thing for bank profitability. But lending needs to pick up. And hopefully that will happen, you know, into next year and beyond. One of the advantages of this fund is we're not benchmark constrained. So unlike a normal fund, you don't have to have 20% of your fund in banks and 15% in oils. You can just literally go and find the individual shares that you think you're going to make money from.
I mean, are there any particular sectors that either you must have, like the defensive you already mentioned with the supermarkets, or the ones you absolutely do not want next year?
I think next year is going to be, in the stock market terms, is going to be very much more stock selection specific rather than sectors. I think the last couple of years have been very much driven by the macro environment, in which case you don't want to own banks, you do want to own mining shares at certain points and not at other points. But next year is going to be, you know, a lot more selective on the stock wise, and that very much plays into our hands.
But looking, as I said, to 2010, optimistic or nervous?
I'm optimistic, but a little bit nervous. I think next year, from where we're sitting today at the end of November, I think we've got a very good opportunity to make a decent amount of money next year. You know, an amount that will make investors feel pretty happy. Next year is not without its risks. I think market volatility will be high. I think there are still some very big issues that haven't been resolved. Budget deficits, quantitative easing, you know, interest rates which are going to go up at some stage, whether it's the first half of next year, the second half of next year, or into 11, they're not going down from where they are today. And that will be enough to keep investors nervous. So, I think for us at the moment, the glass is 45% full. And, we'll stay on the optimistic camp unless we feel that either valuations reflect a more optimistic scenario or events change that cause us to become more cautious.
Mark, thank you very much indeed.
Thank you.
Mark Lyttleton there. And that's it for this week, but don't forget to keep up to date with all the latest news, views and analysis online and of course in the Saturday and Sunday personal finance pages. Thank you for watching and please do join us again next time.